In 1928, Jack Morgan is the most powerful man on Wall Street. Thanks to an era of easy money, he and his fellow bankers set loose the Roaring '20s. The stock market has climbed nearly 40% in just 1 year.
There's a saying about J.P. Morgan Jr. and his partners in the late 1920s. They're called Jesus Christ and his 12 apostles. And so that gives you some sense of the stature of J.P. Morgan Jr. on Wall Street.
Average Joes, lured by the promise of overnight riches, join the frenzy, flooding the market with their borrowed money.
When people see somebody making money on something, they think that could be me too. And so when people would see the price go up in the 1920s, they think, oh my gosh, okay, you're going to feel like a fool if you don't do it.
But all of that comes to an end when the stock market crashes, plunging the entire economy into an abyss. It is the worst crash the nation has ever witnessed. For Morgan, whose fortune is cut in half, he is convinced that the only way to save his business and the country is by ousting President Hoover. He teams up with DuPont, the infamous weapons manufacturer. They rally behind a candidate to challenge Hoover's reign. FDR, an elite just like them from one of the most powerful political families in America. Morgan hopes that once FDR takes office, the president will safeguard their interests and those of their Wall Street brethren. FDR wins the election by a landslide, and his inaugural address instills hope in millions of desperate Americans.
Let me assert my firm belief that the only thing we have to fear is fear itself. And there must be an end to a conduct in banking and in business which too often has given to a sacred trust the likeness of callous and selfish wrongdoing.
Morgan may have helped put FDR in office, but the newly elected leader swiftly turns against him and vows to pursue the bankers responsible for the crash.
As a Democrat, FDR was a very skilled politician. During the campaign, he blamed the crash on Hoover and promised desperate Americans a New Deal. But he was very vague about what the New Deal was.
Through the enactment of the Glass-Steagall Act, commercial banks were barred from engaging in investment banking activities. The House of Morgan is forced to be broken up. It is a stunning setback for J.P. Morgan Jr., one he will agonize for years. The investment banking division of Morgan Bank is spun out to become an independent firm. Jack Morgan makes his son Henry Morgan and their business associate Harold Stanley partners of this newly formed company, Morgan Stanley. The House of Morgan has always thrived on leveraging other people's money, and the birth of Morgan Stanley is no different. The partners of the firm raised over $200 million in debt, while investing only a fraction of their own capital, just a few $1,000,000.
It's a great example of brand equity. They felt at ease taking on huge debt because of the Morgan name.
The partnership quickly becomes the biggest Wall Street investment bank, handling over 20% of all the public offerings. FDR may have forced the House of Morgan to be split up, but the combined net worth of the new companies surpasses the wealth of the original Morgan Bank. By 1936, Morgan and FDR are sworn adversaries. But what they don't know is that the real enemy is 4,000 miles away, and he has built the most powerful military in the world. By 1939, Hitler's invasion of Poland shocks the world, showcasing Germany's unprecedented power. Within 3 weeks, Poland has fallen. Hitler sets his sights westward, poised to consume all of Western Europe. FDR sees the threat in Europe and understands the urgent need for America to prepare for a full-scale invasion.
America's situation, as far as being prepared for fighting a modern war, was pretty abysmal. We had maybe the 18th largest military in the world. Holland had a bigger military than we did. Hungary had a better military than we did.
FDR spent the entirety of his first administration fighting corporate America, making a lot of elites very angry. He referred Pierre DuPont as the merchant of death, and he publicly humiliated Jack Morgan by painting him as the face of the 1929 market crash.
With a growing threat from Germany, FDR realizes he must do what it takes to build up America's military. And to do that, he must turn to the very people he once condemned. FDR makes an unlikely alliance with the House of Morgan, aiming to provide all the finance necessary to turn America into a military power unlike any the world has ever seen. As a part of the House of Morgan, Morgan Stanley joins forces with its fellow investment banks, raising an impressive $5 billion to fund the war effort.
Morgan obviously was looking at the national interest in the context of his own. That is, saving the U.S. was an act of basic self-interest, but it was an act of nationalism.
It's astonishing, isn't it? When a nation faces a common enemy, even people with great differences come together. And the whole industrial America began to operate like a one giant coordinated war machine.
It began at exactly 9 o'clock. A statement by President Harry S. Truman in the White House that he'd been notified by General Eisenhower from his headquarters in Paris that the forces of Germany had surrendered to the Allied nation.
The Japanese have accepted our terms fully. That is the word we have just received from the White House in Washington, and I didn't expect to hear a celebration here in our newsroom in New York, but you can hear one going on behind me.
The massive fundraising during the war helped fortify Morgan Stanley's status as the first-class investment bank.
If I may be permitted to speak of the firm, of which I have the honor to be the senior partner, I should state that at all times the idea of doing only first-class business, and that in a first-class way, has been before our minds.
Investment banking is a relationships business. During and after the war, Morgan Stanley deepens ties with the government and a host of corporations. The firm is perfectly situated to launch into new heights as the country stands on the brink of one of the most prosperous decades, the 1950s. As the 1950s roll into the 1960s, America rides a wave of economic growth, the likes of which the world has never seen. By the decade's end, the GDP more than doubles, reaching astonishing heights. At the same time, Wall Street banks experience an explosive expansion, with their assets soaring from $152 billion to an astonishing $502 billion. As fresh industries burst onto the scene, they turn to Wall Street, hungry for more money to fuel their dreams. Ready to seize this opportunity is Morgan Stanley.
During that time, Morgan Stanley was surprisingly conservative. They wanted to maintain their brand as a first-class business, so they chose to only work with big names like IBM, Sony, and 20th Century Fox.
While the business boomed, the partners of Morgan Stanley maintained a respectable position in the business.
So, until then, money was only part of the reward for working for the firm. Prior to 1986, Morgan Stanley partners could expect to become respectably rich in a respectable way, but not hugely, even excessively rich.
By the late 1970s, a new generation of partners takes the reins as the old guards retire. But they will soon find themselves on the precipice of an impending storm. A new breed of investment bankers emerges, driven by hunger and greed. And they are on a collision course with Morgan Stanley. Salomon Brothers was established in 1910 by Jewish businessmen. Initially a bond trading house, it capitalized on the post-World War I bond market boom. With an aggressive and innovative approach to finance, by the late 1970s, Salomon Brothers is emerging as a competitive force in the investment banking industry. Salomon Brothers see Morgan Stanley as an aging giant that they can take on. All they need now is just an opportunity for an opening move. By early 1970s, IBM is the uncontested leader in technology with its game-changing System 370 mainframe series. To fuel its expansion, IBM plans a hefty $1 billion bond offering, traditionally a task for its longtime partner, Morgan Stanley. Sensing an opportunity, Salomon Brothers offer IBM that they can do the bond offering cheaper and better than Morgan Stanley.
Salomon Brothers were establishing themselves as an expert in the bond market. What does that mean? They had the capability in assisting companies to sell more bonds quickly and cheaply.
In a startling decision, IBM chooses Salomon Brothers as the lead underwriter to issue its debt, and Morgan Stanley just lost one of its most valuable clients.
Morgan Stanley refused to give up the lead. IBM gave Salomon the go-ahead. And after that, every firm on Wall Street lined up to try to unseat Morgan Stanley from the preeminent position in future offerings.
Losing IBM as a client has caused Morgan Stanley to lose tens of millions in revenue. But more importantly, it strikes at the heart of their prestige. As the 1980s dawn, rival investment banks start to redefine the rules of the game and challenge the status quo.
Around that time, a lot of investment banks were growing like crazy. Bear Stearns went public in 1985, and Goldman Sachs was also able to raise almost $300 million from Japanese investors.
At the helm of Morgan Stanley, a new guard emerges, spearheaded by leaders like Dick Fisher and John Mack. To them, to compete with the rising competition, Morgan Stanley needs to go public.
The 100 most recent new issues showed gains averaging 21.2%. The established Wall Street firm of Morgan Stanley, for instance, was among those making their debut this year. Offered on March 21st at a price of $56.50, the stock closed its first day of trading at $71.25.
These companies were very smart to raise money during the peak of the bubble, because to them, it felt like free money.
But for Morgan Stanley, they must anticipate, prepare for the unpredictable, and soon their foresight proves to be right. On the day of October 19th, 1987, the global stock market plunges into a free fall, the Dow Jones spiraling down an unfathomable 22.6% in a single day. While Wall Street stumbles in the chaos, Morgan Stanley stands firm. Their losses a mere bruise compared to their rivals, proving to the world once again that Morgan Stanley is a first-class business.
Before the Black Monday crash, and during the first year as a public company, Morgan Stanley was actively hedging against any potential downturn, while other firms were living in the illusion that the prosperity would never end.
But as the market recovers, and as a public company, the firm is forced to focus on short-term quarterly performance, which means they need consistent earnings.
Either the crash shocked us, or because we became a public company, we became very, very focused on quarterly earnings.
To get consistent earnings, that firm must diversify the sources of profits. As far as Fisher and Mac are concerned, there is only one way to get there. To reclaim their prestige, the top leaders at the firm decide the best path is by merging with another investment bank to expand its business reach. In 1993, they find just the target company. By the early 1990s, S.G. Warburg is one of the most prominent British investment banks. Founded by Jewish banker Sigmund George Warburg in 1946, the firm revolutionized finance by creating the Eurobond market in the early 60s.
In 1994, S.G. Warburg was considered England's leading securities company and represented 50 of the top 100 firms in England. One of the bank's principal attractions for Morgan Stanley was Mercury Asset Management, in which Warburg held a 75% stake. Mercury had a thriving international investment management business, and Morgan Stanley wanted to build strength in that area.
The marriage between the two companies will create the world's biggest investment bank, combining the prestigious names of Morgan and Warburg. The merger looks too perfect.
S.G. Warburg, its investment banking business up for sale and its staff jumping ship in increasing numbers, gave bleak new evidence today of its weakened condition, saying that profits for the year ended March 31st would be well below market expectations.
Hidden beneath Warburg's reputable facade are scars of financial struggle and internal discord. And Morgan Stanley wants no trouble with them. As the potential merger goes south, Warburg has no choice but to sell itself to Swiss Bank Corporation cheaply. But Fisher and Mac remain undeterred. Their vision of transforming Morgan Stanley into the leading investment bank still holds. And before long, a new contender enters their radar. Dean Witter. In 1997, Dean Witter is one of the largest securities firm in America. In just 12 years since 1985, Dean Witter has seen billions in explosive revenue growth, largely thanks to the success of the Discover card. Dean Witter's massive success makes the firm virtually unchallenged in retail finance. And it is all because of one man, Philip Purcell. Born in Salt Lake City, Philip J. Purcell grew during a time of optimism in the 1950s.
Purcell always dreamed of becoming a successful entrepreneur. Even as a youngster, he had this hustler spirit, selling magazines and ironing shirts at a local dry cleaner. From the very beginning, Purcell had an understanding of business at a very practical level.
After graduating from the London School of Economics, Purcell lands a role at McKinsey, one of the globe's top management consulting firms. But to Purcell, being a consultant is not enough. He wants to be the man in charge. McKinsey is merely his launching pad towards greater things. Before long, and by sheer chance, he's about to be given exactly what he seeks. In 1976, the struggling retail giant Sears hires Purcell to design a strategy to enhance and improve the company's performance. Thanks to his ideas, Sears makes improvements, and Purcell is hired as vice president for planning. He quickly rises through the ranks, and by 1986, he assumes the role of CEO at Dean Witter, a Sears subsidiary. Purcell is no longer just a consultant who sells advice for a living. With newfound executive power, he oversees a financial company with billions in assets and tens of thousands of employees. He knows, to take the company to the next level, he needs to find a big idea, something disruptive. And before long, he sets his sights on the credit card industry.
At that time, the market was dominated by American Express, Visa, and MasterCard, all of whom charged a very substantial annual fee.
Purcell thinks he can do better. Instead of making revenues from interests and the annual fees, he envisions a game-changing credit card that not only eliminates annual fees, but also offers cash back to customers. The real money will come from the transaction fees and from merchants.
That gives them some diversity in their business model. It also gives them a really stable source of revenue, at least from the processing side. Very different from the credit side of the equation.
This is the dawn of Discover. The Discover card.
In this world, you get something paid for. The simplicity of the idea is brilliant, and the credit card industry is never the same.
So in 1986, Purcell became chairman of Dean Witter and introduced Discover. In 1992, Dean Witter and Discover brought in $3.7 billion in revenues, with net income of $400 million.
Discover's success turns Dean Witter into one of the world's most profitable and fastest-growing financial service companies. For Mac at Morgan Stanley, Dean Witter may just be the type of company they have been looking for. Morgan Stanley watched in awe as Purcell capitalized on this untapped potential. He generated huge profits for both Sears and Dean Witter, and the millions of Americans celebrating their new benefits.
Morgan Stanley and the rest of Wall Street got a lesson in the advantages of creating access to new markets.
Since the Discover card, Wall Street has started a number of financial revolutions, and one of them is occurring as we speak. In the midst of high volatility and a lopsided market, one company is delivering strong results for their investors, doing something no one had thought possible, just like Purcell's team. They're called Masterworks.
I've invested with them for years now, and they've got a track record with a positive return of over 100%, with an exit just days ago for a 17.6% return.
Masterworks is breaking open a $1.7 trillion market, and like Discover, people are taking notice. Morgan Stanley themselves have studied art as an asset extensively, celebrating how it often experienced lower price volatility thanks to its low correlation to other asset classes.
Masterworks has over $750 million in assets under management, and thousands of my subscribers have invested with them alongside me. I've seen paintings sell out in minutes, but if you use the link in the description, you can skip the waitlist and receive a complimentary art investing guide right away.
As Fisher approaches the retirement age in early 90s, John Mack takes the center stage. The proposed merger with Dean Witter holds the promise of creating the world's largest investment bank, allowing Mack to potentially become the most powerful man in the industry. It is a status Mack has long yearned for since his childhood. Born Born in 1944 to Lebanese immigrants in North Carolina, he always dreamt of achieving great success in the business world.
When he was young, he would wake up at 5 a.m. during the weekends to help his father run the family grocery shop.
And my father, who was an entrepreneur, and he started a wholesale grocery business. My mother was a very strong force. She only wanted to be a doctor, and I really didn't want to be a doctor. My father was laid back, and my mother was really aggressive. It was a great combination.
After making significant strides in Morgan Stanley, Mac quickly earned a reputation as Mac the Knife, known for his ruthless ambition and appetite for risk. Mac knows that merging with Dean Witter will bring challenges to his position as the top dog at Morgan Stanley. But the idea of creating the world's largest investment bank proves irresistible to both firms.
The Morgan Stanley Group, one of Wall Street's elite investment firms, and Dean Witter Discover & Company, which sells stocks and bonds to small investors, agreed to merge yesterday into the world's biggest securities company in a transaction valued at $10.2 billion.
But in a shocking twist of fate, the board appoints Purcell as the CEO, leaving Mac as second in command. Purcell excelled as the leader of Dean Witter, but he has never run an investment bank before.
Investment banking suits very well people who are, it's not good for autistic people. If you're autistic, be a trader, okay? But investment bankers are it's a whole different industry. So yeah, if you go to the symphony and look around, you'll see lots of investment bankers there.
According to the employees, Purcell was a respected, low-profile chief executive and an enigmatic former management consultant. But Mac was an extremely tough, talented, brutal manager. Mac was decisive, ardent, and reacted fast. Purcell was cautious, but Mac was experienced at taking risk.
Purcell knows, while there is peace for the moment, he needs to deal with John Mack soon, before Mac deals with him. Purcell strategically places his loyal allies in key positions within the firm, while maintaining an appearance of cooperation. But Mac rebels against Purcell's directives and despises the rules imposed upon him.
You have to understand that there are people who control your business, your industries. They have more power than others. They have egos. They're insecure. If you don't know how to appeal to them, if you don't know how to appeal to their self-interest, they're not going to finance you, they're not going to help you. You have to understand the political game.
By the year 2000, as Phil Purcell consolidates his power, John Mack finds himself backed into a corner, isolated from influence, until Mack has no choice but to resign.
In a move viewed by Wall Street as the ultimate signal of continued hostilities within the largest securities firm in the nation, John J. Mack resigned yesterday as president of Morgan Stanley Dean Witter & Company after 28 years there.
After forcing Mack out and having key positions at the firm filled with his loyalists, Purcell is now the unchallenged leader of the Wall Street's biggest investment bank. Despite his power at the firm, Purcell has no idea how to run Morgan Stanley.
There was a clash there, and I would say it can be portrayed as a culture clash if you like. But I would say we had a serious strategic difference. People within the company wanted us to lever up more and take more risk. At the time, I didn't agree with any of that.
Purcell's strategy alienates talented employees, leading to a wave of resignations. As a result, the company's performance severely declined. But even with the firm underperforming, Purcell has built an impenetrable wall around him and managed to fend off any attempt to remove him from his CEO position.
The New York Times called Purcell ruthless, autocratic, and remote, and that he had no tolerance for dissent or even argument. He pushed away strong executives and surrounded himself with yes men. He demanded loyalty to himself over the organization. He played power games.
Purcell thinks that he can remain untouched as the CEO of Morgan Stanley. What he doesn't know is that a new threat is emerging. The old guards of Morgan Stanley are returning, ready to launch an attack that will determine the fate of this legendary company. In 2004, Morgan Stanley finds itself in disarray, all thanks to Phil Purcell. His ill-fated attempt to integrate Dean Witter's business with Morgan Stanley has led to a steep decline in performance and a mass exodus of talented employees. Witnessing the company they have helped build crumbling, the retired senior partners, led by Parker Gilbert, realize it's time for them to step in and rescue it.
There was no dialogue, no support. Technical platforms needed to be fixed. But the firm was not going forward, but was struggling like crazy to try and stand still, and in fact was losing ground. Phil had got to go.
But the problem is, Purcell has managed to consolidate power to himself so absolute that this group of 8 men have no actual voting power to oust Purcell. What they do possess is respect and influence.
Although the old guards may have retired, they still commanded a lot of respect and wielded a tremendous amount of influence. So they began to rally employees and shareholders, urging them to unite against the oppressive leadership of Phil Purcell.
Morgan Stanley CEO Philip J. Purcell said Monday he is planning to retire from the Wall Street Investment Bank amid calls for his ouster from a group of dissident shareholders and former executives.
Purcell may have had total power over Morgan Stanley, but he underestimated just how dissatisfied the employees and shareholders truly were. With Purcell's resignation, the exiled king comes back to power. John Mack is about to become the CEO of Morgan Stanley. Mack's comeback is a triumph, but he now faces a company teetering on the edge of collapse. By 2005, Morgan Stanley suffers a staggering $4.1 billion in losses, with its stock price plummeting by 50% since the early 2000s. Mack knows he needs to act fast, or the company will be no more.
In the summer of 2005, everything at Morgan Stanley was an urgent priority. Replace the heads of important divisions, hire a new general counsel, sell the aircraft leasing business, and swallow the write-down. Move the share price up, move up the return on equity, replace most of the board, which was battered, reeling, and publicly embarrassed, so forth and so on.
Mack knows the key to increase profitability is by increasing salaries for top investment bankers and traders. He begins to encourage traders to take audacious risks, aiming for hefty profits. But to truly make a dramatic leap, Mack needs something monumental, a domain where Morgan Stanley can reignite its former glory. And in the mid-2000s, that opportunity presents itself. Mortgage-backed securities.
Somebody originates the mortgage. Okay, that means I talk to the homeowner, I have the homeowner fill out the papers. Then after they've originated the mortgage, they sell it to an investor, okay, like Fannie or Freddie or some private mortgage securitizer. And the private mortgage securitizer finds a mortgage servicer, it may be the originator, who will then service the mortgage. And then we have the CMO organizer, the originator. And then we have the CDO originator. It's gotten to be a very complicated financial system.
To venture into the mortgage-backed securities business, Morgan Stanley acquires Saxon Capital, a specialized mortgage lender that focused on subprime loans.
During this time, mortgage-backed securities were red hot. The world was on a real estate buying spree thanks to easy loans and soaring home values. For the first time, firms, including Morgan Stanley, were buying and selling these mortgage-backed securities to and from each other. We didn't realize that this intertwining of risk held unforeseen consequences. In our hunt for more market share, we also bought companies that originated mortgages here in the United States and in Italy, the United Kingdom, and Russia.
The issuing and trading of subprime mortgage loans turns out to be a huge success. By 2007, Morgan Stanley's revenue soars to nearly $50 billion, up from $34 billion in 2005. John Mack's bet on MBS propels Morgan Stanley back to the top of Wall Street. Alongside Lehman Brothers, Bear Stearns, Goldman Sachs, and Merrill Lynch as the most profitable investment banks. But what none of them realize is that the music is about to stop. And Morgan Stanley is going to fall right back to rock bottom. Just when Morgan Stanley's resurgence seems unstoppable, an unexpected loss hits the firm.
In a sign Wall Street's troubles are far from over, Morgan Stanley announced a $3.6 billion fourth quarter loss, driven largely by a $9.4 billion write-down of mortgage-related investments. For the year, Morgan Stanley earned $3.44 billion, down 62% from $9.1 billion in 2006.
Morgan Stanley is not alone. In a matter of weeks, the world is plunged into the worst recession in recent history. On September 15, 2008, the unimaginable occurs. Lehman Brothers, the fourth largest investment bank in America, declares bankruptcy.
Stunning reshaping of Wall Street as the financial landscape has changed drastically in the past 24 hours. The big news here, Lehman Brothers, unable to be rescued, has filed for bankruptcy.
Mack knows, after Lehman, Morgan Stanley is next, unless he can secure a bailout.
Lehman declares bankruptcy that night. I knew that Morgan Stanley would be next in line. On Monday, our stock started down. I think we went into the week in the low 30s and probably ended up in the mid-20s after the first day.
He tries to approach Japanese investors and even from JP Morgan, but none are willing to assume Morgan Stanley's toxic mortgage assets. Out of options, Mack now fears the worst. But salvation for Morgan Stanley comes from an unlikely source, the government.
I am now supporting today's financial package.
I'm voting aye today, and it may be politically damaging. I've been listening to small business people all week long, and they've said Congress has to act. We're out of options.
It turns out, in order to save firms like Goldman Sachs and Morgan Stanley, Paulson had to transform them from investment banks into bank holding companies. And this very change allowed them to qualify for government bailout.
The idea was that we would present the program to them and ask them within a few hours to sign agreements where they would willingly take the capital, recognizing that they're doing this for the good of the country.
It turns out that Morgan Stanley may have been deemed too big to fail. With government assistance, Morgan Stanley's worst nightmare is over. The firm embarks on an incredible recovery, paying back all of the TARP money within just 2 years. But when you make a deal with the Fed, there is no free lunch. The public is outraged over the blatant government bailout and demands Wall Street banks to pay up. In the years to come, Morgan Stanley, along with its Wall Street counterparts, will grapple with increased regulation and face fines amounting to billions. With John Mack gone, James Gorman emerges as the new CEO of Morgan Stanley. James Gorman comes from a family of 11 children in Australia. He is uniquely equipped to navigate a complex organization.
Gorman is less aggressive and less edgy than Mac the Knife. Him becoming the CEO is actually a turning point of the firm to move away from the risk-taking business of trading to more of a client-facing business of asset management.
To rebuild Morgan Stanley, Gorman believes wealth management is the future. Gorman sees a growing number of high net worth individuals and is betting that after the economic recovery, they will once again need to put their money back to the market. To realize his vision for Morgan Stanley, Gorman will have to find an asset management company to acquire. By 2009, he sets his sight on Smith Barney, one of America's oldest wealth management firms. This acquisition would provide Morgan Stanley with the necessary resources to establish itself as an asset management powerhouse. But before Morgan Stanley fully acquires Smith Barney, the firm faces yet another major setback.
Morgan Stanley plans to cut 1,600 employees starting this week. Two people familiar with the matter said on Wednesday, in the latest sign of a pullback on Wall Street as revenue from trading and deal-making remains in the doldrums.
Before Gorman can pursue his vision to turn around Morgan Stanley, the firm struggles to maintain profitability. To make matters worse, in 2014, the firm's reputation suffers a blow as an employee is charged with insider trading. The arrest further complicates Gorman's mission. But things are about to change. By 2017, the U.S. economy finally recovers, with the GDP climbing, unemployment dropping, and the S&P 500 soaring 40% in just 3 years. And more importantly, the rich continue to accumulate wealth, creating the perfect environment for the wealth management industry. Capitalizing on this growth, Morgan Stanley's money management business takes off as Morgan Stanley experiences its most profitable year in 2017, netting billions of dollars.
Because timing is also critical. Sometimes you hear these stories about too early, too late. And if you feel the urge and you think something is missing in that marketplace, chances are somebody else out there is probably also thinking about it. So you really need to sort of take advantage of that.
Seizing the opportunity, Morgan Stanley acquires more emerging investment companies. For the first time in a long time, Morgan Stanley not only regains its past prestige and market dominance, but it also transforms itself into something new. Even amid the pandemic, Morgan Stanley remains resilient, outperforming its peers.
Their secret to success lies in one simple strategy: follow the money.
In 2023, the firm stands strong with $3 trillion in assets under management. Despite coming close to ruin multiple times, Morgan Stanley emerges stronger, more resilient, and wealthier. Yet, Morgan Stanley is but a small fraction of the enduring Morgan empire, and it pales in comparison to the colossal entity that is JP Morgan Chase, the biggest bank in America.